Hello and welcome to MarketSetup, the podcast where we cut through the clutter, get down to the funda of company performance, and try to find those hidden gems, those potential multi-baggers for your portfolio. I'm your host, Kanchan. After years of advising clients, the whole wealth management gig, I'm now an analyst and investor here at MarketSetup, putting my money where my mouth is, right there with you. So today we are revisiting a company that's been on our radar, operating in a sector that's buzzing with potential, hospitals. Specifically, an update on Yatharth Hospital and Trauma Care Services Limited. They've just released their Q4 and full year numbers, and the management's commentary gives us a lot to unpack. So let's dive in.
First, let's set the stage. Why is this sector so interesting? क्यों है ये sector इतना interesting? Well, India's healthcare sector, it's booming. Rising health awareness, growing income levels, medical tourism, it's all adding up. The overall industry, is projected to grow at a solid 10 to 12% CAGR. But where Yatharth operates, North India, it's expected to be even faster, like a blistering 12 to 14% CAGR. And here's the real kicker. India has just 15 hospital beds per 10,000 people. The global average is 33, less than half. The growth potential, massive, just massive.
And right in the thick of it is Yatharth Hospital. They've carved a real niche, a fast-growing super specialty player in the NCR. 7 hospitals, over 2,300 beds. Deeply into high-value specialities like oncology, cardiology, and neurosciences. So, macro story, strong. Now let's see if the company's performance matches up. Q4 numbers time. Revenue shot up by a very impressive 30% year-on-year. This wasn't just like a rising tide. Their newer hospitals really delivered. The Faridabad unit in no time contributed 9% to the top line. And Jhansi Orcha, fantastic 53% YOY growth. Shows they can execute, ramp up new assets effectively. EBITDA grew by 23% YOY. Now, the EBITDA margin saw little compression, coming in at 24.6%, but this is expected. Aggressive expansion phase, initial costs, it will put a temporary drag on margins. Okay? And that's why PAT, profit after tax, was relatively flat. Higher depreciation costs. Naye assets hain, so depreciation to aayega hi. It's a growth thing, not a weakness. Operational metrics, occupancy climbed to 61%. Great, especially with all the new beds they've added. And now my favorite, ARPOB, average revenue per occupied bed, grew a healthy 7% to over 31,400 rupees. Earning more from each patient, better specialty mix, pricing power, good stuff. ALOS, average length of stay, stable at around 4.2 days.
Zooming out to the full financial year FY25, numbers are solid. Revenue crossed 8,800 crore rupees, 31% jump. PAT stood at 1,306 crores, up 14%. Again, slower PAT growth, expansion-related expenses, same funda. But here's the number I was looking at. Operating cash flow, a very strong 1,496 crore rupees, 68% cash conversion ratio. Matlab, for every 100 rupees of EBITDA profit, 68 rupees became cash in the bank. Ye asli cheez hai. This is the real deal. Okay, numbers look good. But what about the future? Where's this multi-bagger thesis going? Massive expansion. 2 new hospitals, 300 beds in Delhi, 400 in Faridabad, operational next month. Huge capacity jump, hitting the top line almost immediately. CapEx plan? Around 300 crores, mostly equipping these new hospitals, expanding existing ones. ARPOB improvement? Management is guiding for ARPOB at the new hospitals to start strong, around 35,000 rupees, high-end specialties, better pricing. Margins? They expect overall EBITDA margin to stabilize around the current Q4 level, 24 to 25%. Makes sense? New hospitals' initial drag balanced by improving profitability at the mature ones. Risks?
Got to look at those. Working capital cycle is a bit stretched, around 120 receivable days. Government schemes, slow payers, but management has a plan. Newer hospitals, lower government business mix, they want to bring receivable days down to around 80 over the next couple of years. We'll keep an eye on it. Acquisition strategy? Hinting at one more this year. Their philosophy? Own everything, 100%. Land, building, the works. No O&M leases. Better control protects long-term margins. Smart.
So, to sum it up, fast-growing company, high-growth sector, huge tailwinds, aggressive funded expansion coming to life right now, focus on high-margin specialities. Management seems, well, they seem to know what they're doing. Classic growth story. The next 12 to 18 months are key. Watching these new hospitals ramp up. Risks are there, but the potential? Compelling. Yatharth Hospital stays on our watch list. That's all for today on Market Setup. Thanks for tuning in, and I'll catch you on the next one.